Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Well, today we are talking about a solar company. It's Acme Solar, particularly. Well, this is a company which is actually the largest independent renewable power producer. It's one of them, and at the moment it has an operational portfolio of around 2.5 gigawatts and a total pipeline of around 4.4 gigawatts. It's a very recently listed company, which means that there hasn't been as much in terms of price action. However, it has been one which has seen a lot of traction with respect to the entire sector, because this entire sector has been up and about, growing over the last 5 years particularly, where there's been a burst of sorts, even as we see more demand for engineering, procurement and construction services, especially when it comes to the solar business. Well, this particular company is an integrated business model with an in-house EPC and O&M services. They focus on FDRE and hybrid projects with higher internal return rates. And this, of course, by that I mean in comparison to, well, some of the peers in the industry as well. And by FDRE, I mean firm and dispatchment energy. But moving on, as far as building green hydrogen is concerned, well, they do have plans around that as well. And the energy storage projects also come into place when it comes to this particular company. So just like many others in the sector, well, Acme Solar does seem like it's established itself. And of course, the successful listing of the company, followed by a good build-up as far as this order book is concerned, is something that we're going to intend to talk about and take forward as well. But, just to tell you slightly more about Acme Solar before we actually move on, given the fact that it belongs to the solar sector, which has been up and about, in general, 2024 has been a year in which we have seen several IPOs which could potentially be compared to Acme Solar. Now, of course, the sizes continue to differ and vary from company to company, but this is as far as the company is concerned, and we're going to talk a little bit more about the peers as well. But for now, this is how things stand as far as Acme Solar is concerned. But as we always do, we do consider the fundamentals of the company when we consider how the company is done in terms of your income statement. We consider the balance sheet as well as the order book, of course, the cash flows as well, give you an idea about the return ratios. And that's as far as your financial statements go. We move beyond and talk about shareholding, the street credentials, as well as the street coverage and what the street is making of it. And to take us through some of the aspects, I also have with me Mihika Barve, who's going to shed a lot more light and give us a lot more insight with respect to the company. So Mihika, good morning and thanks for joining in.
Good morning.
Let's start by talking about how the income statement has panned out.
Yeah. So if I have to see your 9-month FY25 numbers, how they stand right now, well, revenue is around 1,000 odd crores. You have EBITDA at 917 odd crores. Margins have remained stable since FY22 at 88% and a little bit of change there. And net profit as of 9 months is 129 crore rupees. However, on a year-on-year growth, there is a fall. Even if you see, the compounded annual growth rate from FY22 to FY24, it is on the revenue and EBITDA side, you've seen single-digit, degrowth. We did see an uptick when you compare FY24 versus FY23, but FY22 was higher in terms, and you've seen a fall. Margins have remained stable for all of these years, like I mentioned, but because of this degrowth, we are giving a thumbs down on this one. And it's key to note that the company's revenues are fixed based on PPA tariffs, and the company did see limited capacity additions over FY22 to FY24 to what is expected based on their order book right now. So that could have been one of the reasons. But it's a thumbs down on the income statement, Agam. But how does the balance sheet add up?
It's not bad. It's not bad because remember that the company is in the EPC, so naturally they're going to have some amount of debt, and this actually is on account of, well, the working capital requirements that the company have, or companies like Acme Solar have. And at the moment, it does have a relatively larger equity base. So it has about nearly 2,000 crores in terms of shareholders' equity. Remember, its market capitalization is a little less than 12,000 crores. So based on that, the equity base is not small. And in terms of your cash and cash equivalents, that stands around 533. So it does stand out to be in a pretty comfortable place, at least at this point in time. Sure, its gross debt stands at 1,000 crores too. But for a company of this size, and if you consider the net debt to equity, it's not considerably high. It is in reasonable limits. And of course, we'll get more idea from the management with respect to what they want to do about, where as things stand and the way they have their growth rate cut out with respect to their projects and, the upcoming capacities that will be on stream. So a lot that will be deciphered. But on the whole, at the moment, it does seem like the balance sheet looks all right. So it's going to be a thumbs up. But I reckon that is the order book which has seen a substantial growth.
Yeah, they have, a contracted portfolio of around 6.9 gigawatts. 2.5 is operational, but they've seen a significant, uptick in order book, and they've also executed. So FY24, they ended at 1.4 gigawatts. The expected in FY25 is 2.9 gigawatts, FY26 to 3 gigawatts, FY27 to 5.3 gigawatts, and by FY28, the target is 6.9 gigawatts, and this is, stated by the company itself, and they have most of this portfolio under construction right now. So what we've seen is an estimated growth, and you do see a good uptake, and the growth of the company is determined by how much capacity they add, because that's where their revenues and cash flows are coming in from. So from the order book perspective and the expected and anticipated order book as per management commentary, brokerage notes, etc., does look good. So it's a thumbs up on the order book. Agam, how do the cash flows, shape up?
Yeah, so cash flows from operations are certainly looking at an improvement, and perhaps on expected lines, because we do have an improvement in your operating metrics based on your growing order book, the execution, and the consequent impact on your income statement and your balance sheet, of course. But in general and overall, because of the fact that you do see pretty steady growth coming in, well, I'm not talking about the growth of when it comes to your top line, but I'm certainly talking about your bottom line growth, and your margins have remained stable, because of which they've been able to generate cash flows in general. But on a net basis, it's been a little bit more volatile. They were positive in FY22 and FY23, but that was not the case in FY24. Again, we must remember that the company is making investments into executing an order book, which does give it a good amount of visibility at this point in time, which is why we certainly won't give it a thumbs down for that, and we'll give it a neutral rating. But of course, that negative number for FY24 is something that we can keep an eye on, and whether or not and when it becomes positive, in fact. But it's not been a bad way to go about as far as cash flows are concerned. Again, we must remember that the company also deals with, or rather is an independent power producer, and it does depend on distribution companies to come through in terms of their payments as well. But besides that, there isn't much in terms of, engineering, procurement, and construction services, or operation maintenance for that matter. But that's as far as your income statements go. Let's talk about two of the other crucial ratios here as well. Mika, why don't you take us through them?
Yeah, so first one is our return on, your common equity. You saw FY22, 4%. You did see a dip in FY23, but FY24 is when you saw the real growth, 31%. Now, the company did list last year, and we have to see whether they maintain. But when you look at it from the top, the trajectory is good. But the one I want to talk about is the bid-win ratio. This is basically the company wins its orders by, by bidding in tenders. So this bid-win ratio is dependent on how many tenders it, it bidded for and how much it got allotted and won those. So FY22, 15%. You did see a dip in FY23, 6.5%, but you got to know that FY23 was a year where a lot of asset monetization did take place, so the focus was different. But FY24, it stood at 61%. So when you look at these two key ratios, it's a good picture. So it's a thumbs up on this one. But moving on to street cred is where it does not look good, but neither does the market right now. Yeah. How does that shape up?
No, fair enough. Look, so, I mean, as far as street credentials are concerned, it's been a tough period because firstly, they listed in November of 2024, which was just a few months ago. And do remember that since October, since the month of October, we've seen the markets fall, broader markets even worse. And hence, well, Acme Solar is, and rather its decline in, since its issue has been a consequence, has seen its consequence of being a part of these markets, these falling markets, which means that they've not exactly done very well. Also remember that a lot of these IPOs were listed at a little bit of a premium. Of course, at that point in time, the markets were doing well, which is why the lead managers gave it a little bit of a premium. And that premium, of course, was sold into. In fact, in the last, last 3 months or last 2 months, if you can say, just consider the year-to-date performance, it's been a decline. So it's not been the strongest of them all. But that's as far as street credentials are concerned, which is why we'll give it a thumbs down. Let's talk about shareholders, and how things have panned out in terms of shareholding.
Not a lot of change. Obviously, we don't have historical data because they did, list on exchanges.
Yeah.
As of their November listing, promoter and promoter group shareholding stands at 83%. It's a strong ownership on that point. There's no change even if you look at it at this December ending period. We did see on listing you had a lower DI interest versus FIIs, 5.8%. But over this period you have seen slight shift. DIs now hold around 6.97%. FIIs at 5.54%, while as the other shareholders hold around 4%, and that's remained constant, since the listing. But it looks good on the shareholding point as well, so it's a thumbs up on this metric. And lastly, we come with street coverage, and the stock has been getting a lot of buy calls from the street.
Yeah, I just want to make a quick point in shareholding. Because of the fact that the promoter holding is at around 83%, of course, it is mandated that over the course of the next few years, this particular shareholding will eventually have to come down to around 75%. It's a wait and watch. I'm sure that a lot of these companies in general have some amount of time before the shareholding can come down to the required limit of around 75% and lower. But of course, that's something that a lot of investors may want to keep an eye on. It may require some amount of selling to institutions, and at that point in time it'll be also interesting as to which of these institutions in fact go and buy into the company. Of course, there are several upsides to this as well, because when these share sales do come through, they oftentimes don't happen at significant discounts. Many times they happen at premiums as well, depending on your demand and supply ratio at that point in time. But that's as far as shareholding is concerned. And again, even in terms of the listing, in terms of your domestic institutions, you do have some pretty, well, I would say, some marquee investors who in fact do hold their equity in the companies. Case in point, Nippon AMC, SBI AMC, Tata Mutual Fund for that matter also holds stake in this particular company, which of course bodes well for the shareholding of the company, which is why it's going to be a thumbs up there as well. But finally, we moved on to street coverage and consensus ratings. Now, remember that this company is just listed back in November of 2024, which means that, we don't have too much going in yet. It is tracked by 4 analysts, and all of them are recommending a buy with a 12-month price target of around 310, which means that about a 57% upside from current market levels. So this is a thumbs up here as well. And that actually brings us to your overall rating for the company. If you just take all these into consideration and sum up all the thumbs ups, so, except for the income statement, which actually has the potential to start looking better here on, considering the kind of visibility that the order book, gives you. Well, notwithstanding that, it's a thumbs up for the balance sheet and the order book. Let's move on and talk about the other factors as well. We have good key ratios along with shareholding, and of course, street coverage also giving you an up move there. So, all in all, that gives us a rating of around 5.5 out of 8. So, that's as far as your ratings are concerned. We have the management here with us. But before we go, want to very quickly go through the SWOT here. So Mihika, let's talk about strengths and weaknesses.
Yeah. First is their integrated business model. They do have the in-house EPC and OMM capabilities, which does help with cost advantage when you compare it to a peer like NTPC Green. They also have an potential to expand their EBITDA per megawatt, which is key for something like an Acme Solar. And they have secured cash flows for a long period of time, 20 to 25 years, depending on the PPAs that have been signed. But on the weakness side, they are putting their focus in FDRE and hybrid projects. However, there is a lack of experience because these tenders have just started being floated and have just started becoming popular. They do have a dependence on their top 10 off-takers when it comes to who's buying their, the power generated, and their focus does lie on select states. But opportunities and threats, Agam, where does that look?
This one is a fairly simple one because, in fact, if you consider the opportunity of timely capacity execution, the same thing can be a threat as well. A delay could be a potential threat. And similarly, in terms of opportunities, current favorable market conditions, the way in which the trend is going, the very ambitious target that the government has also set in terms of solar, all these aspects bode well for not just the company but the entire sector. But do remember that because this sector is being thrust, there is also the element of competition, a higher competitive scenario, which could potentially be a threat. But on that note, let's get in Nikhil Dhingra. He's the CEO of Acme Solar. Nikhil, good morning, and thank you so much for taking the time out. It's been a few months here, and it does seem like your company has gone from strength to strength, especially when it comes to the order book. I reckon that demand, of course, is strong from all quarters, including government quarters as well. So I actually want your view on, firstly, the order book that you have at this point in time, the pipeline that you can tell us about, as well as how the order awarding activity has come through in this final quarter of this financial year.
Sure. In terms of the order book in our business, sometimes it gets concentrated, and you tend to win in some periods more than you do in other, because it's a determinant of the policies and the inventory lying with various central counterparties who are REIAs, who are responsible for signing PPAs with the states. In terms of the exposure, I was just listening to what you were saying. The top 10, in the last few years, all of our order wins have been with the REIAs, the central REIAs. So going forward, all of our portfolio will be with them. And of course, they have back-to-back PPA with the states. And that is great for us and all the developers because it's a AAA counterparty. And there is a payment security mechanism which is available with these counterparties. So as far as order inflows are concerned, we have quite substantial orders to execute. We will be executing till 5 gigawatts in 2026, and we'll be going to 7 gigawatts in 2027 as per the PPA timelines. So as far as new projects are concerned, we have seen that they are in the last couple of months. We are seeing that there is a slowdown in terms of the new bids which are coming, and that is because of the transition from a you can say ALCM to ALCM, and also in terms of the PPA signing has become a focus for the REIAs. So we are seeing that the next couple of months there should be a strong order, some bids which will be coming, and government has also mandated that now all solar needs to come along with storage. So that's a key change which will be very good for taking renewable into more of a predictable source of power, and that is a very good move for the grid stability as well. So we'll see a lot of tenders coming up in the new regime where the cells need to be procured domestically. As far as we are concerned, with our order book, we have a exponential growth if we are as we are planning to deliver these projects. But as far as new orders are concerned, we are looking to take new orders which allow us to build our pipelines till 2030, as we have a target of around 10 gigawatts by 2030. And accordingly, we have taken connectivity, and accordingly, we are building our land bank and the team. So we are looking for new orders, profitable orders, but all of them now, just to be clear, will be coming in hybrid and FDRE or battery. It is now mandatory part, so there is no option but to for every utility like us. These FDRE, hybrid, and battery are something which you have to do, because no longer will you have a plain solar tender coming up.
Mr. Dhingra, you've mentioned how the energy storage mandate has coming, and you're going to see that as a part of every tender next. How does that change on how the company, executes? Could that add to maybe execution timelines? Because previously that wasn't a part of the process. So what needs to be, taken up by the company? What needs to change?
Yes, it's a good question, because it's a key change in terms of the overall project. So first, on the before execution, I would like to say that it makes our power more appealing for the counterparties, because we were seeing that some of the states in India have a lot of already have tied up a lot of solar capacities. What they were looking for is the peak power, because there is a peak deficit which is higher as compared to the base load, where government has done a great job in terms of increasing the supply of electricity in the country. So what we are just seeing is the remaining peak deficits. So this power is something which is very much desirable by all utilities. So there is a great demand for it, and that is where players like us come into being. And of course, the renewable energy industry as a whole is now focusing on all these projects. In terms of the execution risk, batteries are on the lower side as far as execution risk is concerned. In terms of the procurement and installation, they are far simpler than installing a solar or a wind plant. The risk with batteries are more in terms of as a country, we have not installed much batteries, but globally, batteries have been installed on a very large scale across US, China, Australia, and various other countries. Because in India, the pricing has been a concern. The batteries pricing were on a higher side, and of course, we were still on our growth phase in terms of the deficit in power. Now that we have substantial renewable in the country, batteries or any kind of storage, be it pumped storage, are mandatory part of the grid. So in terms of execution, I would not say batteries add to the risk. Of course, they add to in the procurement side of things, planning side of things, the technology selection kind of thing. They add to some extra work, but that's a welcome work, because we are being compensated for that extra work through an increase in tariff, which makes the projects more, I would say, attractive for the customers, attractive for the sellers. So it's a good kind of addition.
But would this, mandate also maybe increase the cost for setting up a project? Because like you said, there are, things that you have to look out from the procurement. Could that have a hit on your margins, which have remained stable since FY22?
So, in terms of the margins, our business is fairly predictable post we win the bid, because in terms of the project we win, the revenues are stable for 25 years. So the only risk in terms of our sort of business is whether you are bidding with the right sort of assumptions in terms of capex and operational assumptions. So primarily, all of our projects are centered around a large component of solar power, right? There will be storage, and there will be a little bit of wind. So in terms of the solar, we have around 15 years of experience in terms of executing these plants, looking at the generation data across all the states in India. So we are fairly comfortable with the variability in that source of power. In terms of the cost, so the cost is always in sync with the tariff, because when you are bidding, there are no unknowns as far as your scope of work is concerned. There is a clear mandate to what you need to install, and there is a clear sort of tariff which you get in the reverse auction. There are no new components which you find out after the bid. A company like us, which does our own EPC and of course have been doing it for last 15 years, we have a fair idea of what is to be installed and where it has to be installed, where do we have connectivity. So in terms of there is no unknown. So cost, if it is known prior, it does not add to the risk, because you can price it in your tariff bidding. So there will be, of course, increase in the cost. The cost for all the FDRE and hybrids are higher than the solar plant, but the tariffs are also much higher. And of course, the CUF which you do from these plants is also higher. So the amount of power and the price of power both are higher in these bids, and that is in sync with the higher cost.
Right. And Nikhil, a final question then. in terms of assessing your balance sheet, are you comfortable with these current debt levels? I reckon that a lot of this will be used for working capital. Are you looking to reduce this gross debt? If you could also give us a picture on internal accruals of whether or not they will be enough for now when you take on your expansion and also executing your order book.
Sure, sure. So we have done a lot to reduce our debt since we listed, right? We have reduced debt by around 2,100 crores since we listed. So as you will see in the in the last quarter where we declared results, we have mentioned that we have repaid debt of to the extent of this much 2,100 crore, because in the last quarter and this quarter we have done that. So the debt has quite reduced in terms of our operational EBITDA to debt. Right, we are around at a much lower number. Our target is to be under 5.5, because our EBITDA, as you would understand, we are not like conventional manufacturing companies. We are getting 25-year revenue, which is actually an exception. If you look at any company, 25-year stable revenue is only available in a utility business, and more so in renewables, because even the EBITDA margin is fairly stable because there are no operational costs like fuel cost, which is dependent on outside factors. Other than the interest rate, there is actually nothing which changes on a year-on-year basis, and that also has been fairly constant for because of the government push on the renewables. We have been getting financing within a range in terms of the good projects. So there is in terms of the debt, we are at a lower level. We have around 6,500 crores of net debt, and our run rate EBITDA is around 1,800 crores. So quite comfortable. In terms of our net worth, I was just seeing what you. So we have a net worth now of around 4,500 crores, because it is not around 2,000 crores. That is pre-IPO. So post IPO, our net worth is now 4,500 crores. So just to correct the numbers, I think you were showing. I was waiting for you, so I saw the numbers. So in terms of the debt to EBITDA, we're quite comfortable. And as we move forward, we will always try to keep the operational debt to EBITDA within that range of 5.5, because our debt are 20-year debt. So it is not a debt which needs to be returned in a short period of time. So this has to be in sync with the cash flows for 25 years, which a PPA generates. So I think as we move forward, we will always, you also mentioned that we may need to raise equity in the next 3 years. So our current capacities and current cash flows are sufficient to do the capex we want to do. But let's say if we need to raise equity in the next 3 years, we will see if we have any debt reduction more, something we need to do to reduce the debt. We will always do that, because we will never want to increase the debt amount beyond a debt to EBITDA of 5.5.
Right. No, Nikhil, point taken. Also, your point taken on post-IPO balance sheet updates, which, of course, we will make those respective corrections, but completely out of time. So thanking you for joining us and giving us a lot more clarity on the company.
Thanks a lot. Thank you for having me.
All right, there you have it. That's the management of Acme Solar telling us about all that is in store for the future. But that is all that we have in this edition of KYC. But lots more lined up on the other side. Stay tuned to NDTV Profit.